Have you ever wondered why things cost what they do? What forces drive the price of your favorite pair of shoes or the cost of your morning coffee? Welcome to the fascinating world of supply, demand, and market equilibrium. Imagine a bustling marketplace. On one side, we have sellers with their goods and services. This represents the supply. On the other side, we have buyers eager to purchase. This is the demand. When these two forces meet, we have what we call market equilibrium. But let's delve deeper into these concepts. What is supply? Simply put, supply refers to the quantity of a product or service that producers are willing and able to sell. It's driven by factors such as production costs, technology, and competition. If costs fall or technology improves or competition decreases, suppliers can offer more at each price, and the supply curve shifts to the right. Then we have demand. Demand represents the quantity of a product or service that consumers are willing and able to buy. It's influenced by factors such as income, tastes, and expectations. If income rises or tastes change favorably, or expectations are of higher prices in the future, consumers want more at each price, and the demand curve shifts to the right. Now, what happens when supply and demand meet? This is where the magic happens. The price at which the amount that producers are willing to supply equals the amount that consumers are willing to buy is called the equilibrium price. The quantity associated with this price is the equilibrium quantity. In a perfect world, markets would always be in equilibrium, but we know that's not always the case. If the price is too high, supply exceeds demand, and we have a surplus. If the price is too low, demand exceeds supply, and we have a shortage. Over time, these imbalances put pressure on the price to change, pushing the market back towards equilibrium. So, to sum it up, supply is about what's available and can be influenced by production costs, technology, and competition. Demand is about what people want and can be shaped by income, tastes, and expectations. When supply and demand meet, they determine the price and quantity of goods and services in the market, creating a state of equilibrium. But remember, markets are dynamic and things can change. Prices can fluctuate due to shifts in supply and demand. When that happens, the market may experience temporary periods of surplus or shortage. But don't worry, the invisible hand of the market usually guides it back to equilibrium. Understanding the concepts of supply, demand, and market equilibrium is crucial. It helps us to make sense of how markets work and why prices change. It's a fundamental part of economics, and it applies to almost everything we buy and sell. So next time you wonder why your favorite pair of shoes or your morning coffee costs what it does, remember, it's all about supply, demand, and market equilibrium.